What are primary markets and secondary markets? I have already explained the concepts earlier, and here are some more points that you can memorize and use in your short and long answers. Primary market is also known as the new issues market because it deals with new securities being issued for the first time. For example, when a company makes an IPO, that is an initial public offering of its shares, or issues debentures or bonds, the transactions are considered to be happening in the primary market. The primary market facilitates the transfer of investable funds from the savers or the investors to the entrepreneurs or the businesses. For example, when investors apply for an IPO, the company gets the money. After that, whenever these securities are sold and resold, the transactions are happening between investor to investor, and they are happening in the secondary market. And the company does not get any more money from these secondary market transactions. Primary markets help in establishing new enterprises or expanding existing ones through the issuance of securities, because they make money available to the businesses or to the entrepreneurs to set up new enterprises or expanding existing ones. The investors involved in the primary markets include banks, financial institutions, insurance companies, mutual funds, and individuals, that is the general public. The forms of capital raised in the primary market are equity shares, preference shares, debentures, loans, and deposits. And the purpose of raising funds in the primary markets might be for setting up new projects, expansion, diversification, modernization, mergers, and takeovers. After securities are issued in the primary markets, they can be bought and sold in the secondary markets. This is why the secondary market is also known as the stock market or the stock exchange. It is the marketplace for the purchase and sale of existing securities, helping investors disinvest and allowing new investors to enter the market. This means that investors who acquired the shares or the securities in the primary market can exit by selling them in the secondary markets, and new investors can buy these securities and enter the market. The secondary market provides liquidity and marketability for existing securities, allowing them to be easily converted into cash. Secondary markets contribute to economic growth by funding the most productive investments through divestment and reinvestment, which means that the money keeps flowing through the markets. As a regulatory authority, the Securities and Exchange Board of India, SEBI, controls and oversees secondary markets to ensure transparency and fairness. So the secondary market enables the sale and subsequent purchase of shares and securities, all within the regulatory framework provided by SEBI. Additionally, advancements in information technology and internet have made stock exchanges accessible from anywhere in the country, enabling people from across India to participate in economic activities. And over the last few decades, along with the growth of the primary market, the secondary market has played a significant role in diversifying the investment opportunities for people across the country and generating wealth for investors from across India.